Joining us now, Alger CEO and CIO Dan Chung. Dan, good to see you.
Good to see you.
Thanks for coming by. How do you read the current environment? You said we might be at the beginning of a bull market. Clearly, we had a big gain off that low 11 months ago or almost 12 months ago. Giving back some of that, especially in the average stock, what's the environment feel like to you?
Well, since a year ago, we've had about 7 months up out of the last 11, 12. So I think it's a natural process since late summer, since August. We've had 2 months of correction, pull back. We expect a little bit more. It's natural. We see still strong economy, but we also see the Fed still fighting the fight with inflation, likely to do one more interest rate increase in November, we think. But that is towards the end of the process, and that's why we think we're already probably seen the bottoms of this market really a year ago at around 3,500. This is a natural pullback in what I would call a new bull market.
Can you really say that, though, if you know that we haven't seen the highs on yields?
Well, we haven't seen the highs on yield. Well, we've seen highs since, right? The yields right now are at peaks.
New cycle highs.
Going back to 2007, which is interesting. The Fed, I think, will likely do another 25 basis points in November. But I think there's a very high probability that they're sort of done then. And at that point, we still have an inverted yield curve. So, the best bet would probably be short-term treasuries right now, 2 years at 5%. But I think the equity markets, will sense the end of that cycle, rate cycle, and respond positively.
If you're talking about a 5-year time horizon, now in the trailing 5 years, I think the S&P's giving you like 11% total return. Not bad, pretty much, historical averages plus a little bit. Presumably, you're going to have to get through maybe a recession and earnings downturn over that span. How is stock set up for that trajectory?
Well, I think one thing that's really interesting to look at is earnings projections in the S&P. Actually, they have started to grow again as of the second quarter. Third quarter will be an acceleration. And it's a reminder that the S&P, the highest quality growth companies, the highest quality companies with barriers to entry, free cash flow, they're actually doing quite well in an economy that is actually still doing quite well. Look at the JOLTS report this morning. So we think that's where investors will want to be for the long term. Meanwhile, there's going to be some short term, I think, choppiness. And
in terms of within the market, you would stay oriented toward higher quality and growth or other areas?
Well, it's notable that the big seven, right, the big Microsoft, Amazon, Apple, et cetera, the top 7 stocks in market cap have absolutely dominated this first move in what I would call the bull market. And it makes sense. They're all high quality. They all have incredible brands. Free cash flow is tremendous amongst them. So they've been like 75 to 80% of the market move so far. I think that's a positive in the sense that there's still 90+% of the S&P that's actually kind of in a bear market or barely off the bottom. And I think when that starts to rally, we're going to see a much more broadening equity market. And that's what we're looking forward to over the next 3 to 5 years.
Because you guys invest in multiple asset classes, right? So how much are you increasing allocation to equities right now?
So our allocation, we're primarily equity investors. We do have long-short hedge funds. The hedge funds are positioned for the rockiness right now and quite defensive in the sense of we're not interested in the utilities. We're short real estate. We're short a lot of the interest rate sensitive areas of the market. But meanwhile, we've maintained a long bullish position in the big 7, so to speak, not all of them, but companies of that kind of character, right? High free cash flow, strong growth, big barriers to entry.